right, good to have you with us. It is a busy summer week here as we digest earnings on both sides of the border and the latest on the trade front. We've been covering this high-profile trade deal between the U.S. and Japan. Of course, yesterday, the Prime Minister, Mark Carney, said Canada's not going to rush to a deal if they can't get a good one for the country. Some might make the argument that did Japan get the best deal they could get? But in the eyes of the markets, just having some trade certainty is satisfying and could keep stocks moving back into all-time high territory. Lesley Marks joining us here in studio to talk about all of these matters. She is Chief Investment Officer at Mackenzie Investments. Good to see you.
Good to see you, John.
Sort of the idea of just getting a trade deal done with a big country like Japan and the market seeing that as a positive, does that surprise you?
Well, I think it's a very good trade deal for the United States. I think the fact that there's some innovative aspects to it. Treasury Secretary Bessent this morning was talking about how they got the deal done, which I think is really important for your viewers to understand, which is really related to this financing deal where Japan has committed over $500 billion to invest into the United States. And I think that's what really allowed them to get a better deal than they otherwise would have gotten. And so it makes you think, well, what are the other regions going to do? What is Europe going to do, the European Union? What is Canada going to do? I mean, is that going to be what has to happen? Does Canada have to come with some novel idea to the table in order to roll back the very aggressive tariffs that the United States has put against Canada?
Yeah, I'm glad you brought that up because in terms of the components of the Japan deal, there's the commitment to more than $500 billion worth of investments into the United States. The tariff story tied to autos is interesting in that Japan, basically the tariff rate on imports, including cars from Japan, everybody's sort of weighing in and debating this, but I've even seen some analysts saying that for the U.S. automakers, ultimately that could be a way for them to get more vehicles into the Japanese market. We'll see what happens on that front. And then Japan, I think they're buying 100 Boeing aircraft. They're boosting rice purchases. They're spending like $8 billion on agriculture and other products, and then hiking their defense spending with American firms. So, I mean, I guess if we were looking at this, with the term trade, we often talk about sports trades. Which team got a better deal? And so I guess that's what you're referencing here.
Yeah, I mean, I think it remains to be seen which team in this case got a better deal. We don't have all of the details of the trade deal. We don't know the extent of the commitments. What are the requirements to deliver on the commitments? Is there the ability, is there a market out clause with some of those commitments? We don't really know at this point in time. But the important thing is certainty. And I think that's what investors are really looking for. And particularly with respect to Japan and the Japanese auto industry, this was going to be a very contentious negotiation because the Japanese auto industry has the United States as a very important export market for them, and it's an important industry for all of Japan. So I think the fact that we have this deal, we have certainty, is what the market likes. Now, having said that, you've seen the futures, you showed them on your screen. I mean, they're certainly not what what we saw in the Japanese markets overnight.
It's more of a 3% move.
Yeah, 3% move in Japan, looks like 0 to 0.5% move over here in the United States. That shows you that the market was not too concerned about this deal and isn't breathing that same sigh of relief for the United States or U.S. stocks that Japanese investors are.
I'm glad you brought that up because I think, there's like some experts have talked about how the market just got used to the back and forth on trade and now they're sort of shifting into another gear of focus. Is it possible that this is maybe sort of a hedged reaction, A, because we're already at all-time highs, and B, because, just to highlight, the European Union is ready to impose like 30% tariffs on more than $100 billion worth of American goods if they can't get a deal done before August 1st, assuming, we don't change the goalpost on that deadline of August 1st. And then the Prime Minister, Mark Carney, even yesterday was talking about how, we don't want to get a bad deal for Canada and even meeting with the premiers, like it's hard to know how every country is going to navigate this, and so there is that unknown, I suppose. At the end of the day, how much focus should investors put in the back and forth on the trades? I mean, nobody's a trade policy expert, and certainly not in this very unique case as well. So how much time should you invest yourself in the trade headlines?
Well, I think the most important thing to think about with trade as an investor is that although the United States has come out very hard on the trade file and tariffs, and we've seen very large tariff income coming into the United States Treasury, the most important thing is there's always an off-ramp. And I think that's what investors are really focused on right now and why markets are near all-time highs. If things start to be very destructive to the U.S. economy, to the stock market, to the bond market, we've seen it before, there is always an off-ramp. There's always the ability to reduce tariffs, to negotiate a better deal. And so I think that's what the market is really focused on, is that this idea that the administration has shown that they are not in a position or they are not interested in destroying the U.S. economy in the short term in order to gain on the tariff side. But really, they've been using tariffs as a negotiating tactic to extract things that they want. And Japan is such a great example of that. So I think what investors can do is take the Japanese trade deal, at least what we know of that deal, and extrapolate that to the other larger regions that are still to be negotiated.
And I think against that backdrop, if you look at the last 3 months of North American equity performance, because I know for the year the TSX is doing better than the S&P 500, but over the last 3 months, the U.S. has outperformed Canada. In both cases, tech stocks were going up, but sometimes it's simple math. Like, people roared back into the tech sector, maybe because of what you're saying. People felt like when things started to get shaky, that the Trump administration pulled back, and then investors really went back to these big winners, these big growth companies that are going to be in focus this week.
Well, it's true. When things started to get shaky, what cracks the most, it's the highest valued names. So the large cap tech stocks got hit very hard in the early days of the sell-off. But then when the president moved away and gave a 90-day reprieve for all of the trade negotiations, and people started to realize, any tariff impact is going to have less impact on these larger cap technology names, and people started to feel more comfortable investing in general, they started to really pour back into those names. So what we've seen since that end of April time period is a huge gap in performance related to companies that have very, larger cap companies has been the most dominant factor, as well as 3-month earnings per share momentum. And those names still have the strongest earnings momentum right now. So you've continued to see the same trends that we saw in 2024 over the last, call it, 3 to 4 months as the market has recovered and hit new highs. And that's that high concentration in the largest names and mostly technology shares.
So with all that said, what I was going to ask you was, like, what's your sector strategy right now? Like, do you stick with those names that are, changing the world through all this AI investment? Do you focus on what's the thinking at this point?
Well, I think there's still a very strong fundamental story in those names. And I think as an investor, you should never turn your back on strong earnings momentum. It historically has been one of the most important factors driving stock prices. So right now, that's where we see the greatest earnings momentum. You can contrast that with some of the, for example, automotive companies or CN Rail, which you've just seen reporting, and you've seen some of the tariff headwinds. Now, if the United States is bringing in $300 billion in revenue from tariffs this year, which seems to be the current number that's being thrown around by Treasury Secretary Bessent, somebody is paying that. And what we are seeing right now is that corporates are taking on those extra tariff costs. But that's not the large technology names. It's more of the industrial names like the automotive and rail sector, et cetera, where we're starting to see that show up in their earnings outlook. So the market is, GM, exactly, Stellantis. The market is very bifurcated. So when it comes to looking for earnings momentum, right now the earnings momentum still exists in the larger cap technology names.